I think we suggested that there was going to be a red sweep, so we were reasonably well positioned for it.
Okay.
It was certainly non-consensus at the time. The way we positioned for it leading in was to be long Japanese equities. We had about 15% of the portfolio ahead of that going into the election. After the Fed meeting, we actually added to that position, so we've taken Japanese equities up to 20%. Importantly, what we've done as well, when we added to that back on the 5th of August, was buy the dollar yen, so we hedged the currency also. So we've got about 20% long US dollar yen, and that's been quite good for the portfolio also.
That's paying off now, right?
Yeah, absolutely. So I think that those two key positions have been right. And clearly it's been more challenging for other parts of Asia. We did also add, I should say that we added to banks in Asia Pacific. We still see that as a sector that's undervalued. Trades on about 7 times earnings, 11% trend return on equity, 6% dividend yield. So we do like that sector as a sort of a non-contrarian.
And we can get on to just how inflationary Trumpian economic policy is going to be. But does this all add up to meaningfully higher longer-term bond yields, meaningfully higher dollar, and do risk assets have a lot of work to do then after inauguration and January the 20th in pricing that in?
Look, clearly the initial reaction was a higher potential path of rates. There's been a rise in yields and dollar strength, and I think that consensus belief was broadly right. But it's plausible, and we take a contrarian position on this, that it's still too early to say. That it depends on how the policy agenda plays out, and also over what length of time. When clearly, if taken to its literal extent, it probably means arguably to take about a percentage point off growth. It adds about a percentage point to inflation if taken literally. But a lot of things could play out differently.